Nowadays, we have a lot of very big corporations in the world that are well known globally. Among these huge companies, we have Apple, which in 2020 reached a market cap of over $2 trillion and is today the most valuable company in the world. We have Tesla, which already has a total of 6 big factories among 3 different continents and produces over 1 million cars a year. Or Coca-Cola, which has been around forever and owns a lot of different brands. Now imagine you could take your entire business, either Apple, Tesla, or Coca-Cola, and put it into a single piece of paper. That piece of paper would be the balance sheet. And today, we're going to talk about it.
Hi guys, Gabriel here from Sowing Sense. In this video, we're going to go over everything you need to know about the balance sheet. This will provide you with very important information about the business you're looking into, and you will use it a lot for fundamental analysis to decide whether a company is good or not to invest in. So let's get into it.
The balance sheet shows us the assets and liabilities or debts that a business has. So basically, it tells us what a business owns and owes and the ability the company has to pay its short-term and long-term debt. So in simple terms, the bigger the assets figure is compared to the liabilities, the more able they are to cover their debts, which is a good sign. The balance sheet also helps us know the company's net worth or book value by subtracting all the debt from the assets. I'm going to be using Morningstar for this video, and we'll review Coca-Cola's balance sheet. So let's search for it, and once we have, we'll find the balance sheet under financials, along with the other 2 statements, which are income statement and cash flow statement. Now, the balance sheet alone is not enough when you analyze a company, so make sure you review those other 2 statements as well. You can find the links of the videos where we cover them in the description below. Keep in mind, before we start, that all these numbers are shortened by 6 zeros, so whatever figure you see here is actually in millions. These, for example, are actually 9.5 billion. When we go into the balance sheet, the first thing we see are all the assets the company owns. These total assets are divided into current assets and non-current assets. Current assets are those the business owns and is planning to sell within the next 12-month period. And non-current assets are those long-term assets the business is not planning to sell soon, or at least outside those 12 months ahead. And just to make this a lot easier for you in advance, the liabilities section is structured just the same way. Current liabilities being the short-term debt the business plans to pay within the next 12-month timeframe. And non-current liabilities show you the long-term obligations the business has that doesn't have to pay within that period. Both current and non-current liabilities also equals total liabilities. That being said, let's explain each component from this balance sheet. Under current assets, we have cash, cash equivalents, and short-term investments. This is, of course, the cash the business has, and cash equivalents refers to things they own that could be sold in the market or liquidated, such as furniture, properties, cars, planes, etc., and are planned to be sold within a year. So here we can see Coca-Cola has 9.5 billion between cash and cash equivalents to sell within the next 12 months. Short-term investments are investments the company has probably in different companies, for example, if they own stocks in another business, and plan to liquidate or turn these investments into cash within the next year. These 2.1 billion is the amount they expect to receive from those sales, for a total of 11.6 billion between cash, cash equivalents, and short-term investments. Inventory is the stuff the business owns that plans to sell within the next 12 months. This is mostly raw materials like aluminum, oil, gas, plastic, etc., depending on the business, and also their finished products they sell to retailers after all manufacturing process. In their case, these could be the sodas as we see them in the store. So they have 4.2 billion right now in inventory for sale. Under receivables, you'll find accounts receivable and allowance for doubtful accounts. Accounts receivable is the money owed to the company that has not been paid yet, but is expected to be received within 12 months. An example of this could be the sales the company made on credit. Let's take Ford as an example. Most people buy cars on credit, but not everybody is going to pay on time or even pay the full amount. And that is where allowance for doubtful accounts come. To be conservative, companies make an estimation of how much from the amount owed they are not going to receive. For that reason, this appears as a negative figure and is subtracted from accounts receivables. So Coca-Cola has receivables of $4 billion, but they estimate that $516 million from that debt will not be paid for this period, for a total of net $3.4 billion expected from accounts receivables. Then we have other current assets, which is basically other things the business plans to sell within a year. And down here, assets held for sale or discontinued operations. They don't report any, but just to briefly explain you what it is, it refers to a part of a business that's being sold or held for sale, and whatever profit or loss they realize after will be reported here. For example, if they want to close an unprofitable department, eliminate a product line, etc. We have ended the current assets section, so overall, they estimate $22.5 billion will be received in current assets within a year. Where do we get that number from? We simply add the total cash, cash equivalents, and short-term investments, total inventories for sale, and also their net receivables and other current assets together. We will now go to the non-current assets section of this balance sheet. This shows us the value of all the long-term assets the business has that will not be sold at least within the next 12 months. First, we see property, plant, and equipment, or PPE, and it's basically the value of assets such as land, buildings, furniture, etc. Here it breaks it down a bit as well. This whole section belongs to property, plant, and equipment. And down here we have the depreciation and amortization. Most assets lose value over time. It happens if you buy a phone, a house, a car, and this figure is the depreciation that the company's property, plant, and equipment has over time. For that reason, it appears negative and is subtracted from the value of their property, plant, and equipment. If you notice, it keeps increasing year over year, which is normal. But of course, the smaller this number is, the better for us. Coca-Cola currently has a property, plant, and equipment worth $19 billion, minus a depreciation of $9 billion, so their net property, plant, and equipment is worth around $9.8 billion after depreciation. Now we have goodwill and other intangible assets. Even though they're both intangible, they are different. Goodwill refers to things a business has that add value to it, but you couldn't sell individually if you owned the business. And Coca-Cola is a great example of it. They have built intangible benefits over time that add value to them as a company. You know, the fact that you're able to recognize their logo as soon as you see it, and the time that they have been in the market, loyal customers, business reputation, they're well known globally, etc. Those are examples of goodwill. So this number we see here is what Coca-Cola has paid in goodwill for companies or assets they have acquired. Now, how do you pay for goodwill? Let's say you buy a Rolex, and that model you bought is usually around $10,000. However, there is a specific watch from that same model, but this particular one is worth $50,000 because it happened to be owned by a very famous celebrity, making that one a lot more valuable, even though they're identical. So we could say you paid $40,000 in goodwill by purchasing the watch, which is the extra amount you paid from what it's actually worth. The same way works when a company takes over another business. This business they want to purchase has a certain net worth, just like the Rolex that was actually worth $10,000. But if they have been in the market for quite some time, they're well known in their area, and have been able to build a solid and stable customer base, they usually get an additional monetary compensation because of these intangible benefits that is usually agreed upon both parties during the negotiation. However, if you bought Coca-Cola today, you would not be able to sell any of those benefits because you can't sell, let's say, brand reputation individually without selling your entire brand. Just like you can't sell the fact that your Rolex belonged to a certain celebrity without selling the watch itself. And that's where it differs from other intangible assets, as these can actually be sold independently, and are easier to put a price in them. These are things like author rights, licenses, patents, etc. So all these figures could be author rights or patents they bought from other businesses, and so far, their total goodwill and other intangible assets for 2022 are worth over $33 billion before amortization. So all these sections shows the different amortizations that their intangible assets have over time. And this is basically pretty similar to depreciation, as it shows how the net value of a certain intangible asset decreases relative to their useful life as time passes. For example, if Coca-Cola introduces a new machine to manufacture their products faster, and this machine, that is worth $1 million, has a patent for 10 years, then the amortization on that patent will be $100,000 a year until it expires. So after all these amortizations, there's still over $33 billion in net intangible assets. These are long-term investments they have, such as stocks in other companies, but they're not planning to sell these within the next 12 months. In Coca-Cola's case, for this year, they hold $18.7 billion on investments. Non-current deferred tax assets are returns in taxes the business expects in a period longer than 12 months. This is usually due to a tax overpayment in a previous period that will result in a tax relief or income tax reduction in the future. Other non-current assets are basically other assets the business owns for the long term, where they have $6 billion. And with this, we have ended the assets section of this balance sheet. Their total non-current assets are worth $70 billion, which we get by taking our net property, plant, and equipment, net intangible assets, total long-term investments, deferred taxes, and other non-current assets. Total assets are worth $92 billion, which, as you already know, is current plus non-current assets. Now we'll get into the liabilities section of Coca-Cola. So, under current liabilities, or short-term debt the business has to pay off within the next 12 months, we have accounts payable and accrued expenses. Let's explain both of these and how they differ from each other. Accounts payable is the money the company owes to their suppliers for services or goods that have been provided or delivered but has not paid for yet. However, an invoice for these services and goods has already been received from their suppliers, with the exact amount owed. Accrued expenses, on the other hand, refers to all those ongoing expenses and obligations a business has accumulated, either because an invoice has not been received from their supplier for services or goods they have used but still owe, or because the payment of certain services already consumed is set to be billed at a later date. So accrued expenses are usually an estimate of what the company has to pay for certain things until an invoice is received with the exact amount owed. Examples of this could be all the utilities the company has already used during the entire month, like water, gas, electricity, etc., but a utility bill has not been received, or the wages they have to pay to their employees but will not be paid until the end of the period. When it comes to the accrued expenses that are generated for services or goods from their providers, let's say that Tesla buys batteries from Company X for their cars. Usually, Tesla will be allowed to pay later for the supplies provided by Company X, in this case the batteries. The payment period they both agree will be 90 days after. If, during the first, let's say 30 days, Company X hasn't sent Tesla an invoice for the batteries provided, this will remain under Tesla's accrued expenses as an estimate, and it's not until Company X sends a bill to Tesla that it will be adjusted to the exact amount. So now you know what these two figures are. In this section, we can also see tax payables, and I just wanted to briefly go over it just so you're not confused with income tax. Taxes payable is what the company has not paid yet to the government for prior income taxes, so it's a debt, which is why it's different from the income tax expense reported in the income statement. That is basically the amount of taxes they have to pay for the income generated in the current period. This year, Coca-Cola has $15.8 billion between accounts payables and accrued expenses. Now, under financial liabilities, we have current debt, capital lease obligation, and also a portion of long-term debt. So let's begin with current debt. This is different from accounts payable because this last one refers to the debt the company has for goods and services, but current debt refers to actual cash or funds the business has borrowed. So it's basically the debt they have on loans they took. Now, before getting into portion of long-term debt, let's explain what a capital lease obligation is for better reference, as both of these could be connected. And if you notice, capital lease obligations also appears in the non-current liabilities section. So what is this exactly? Most businesses do not own the machinery they use to operate, but they have a capital lease agreement with the provider. A capital lease agreement is like an operating lease, which is a normal renting agreement, like when you rent a house for a year, you make monthly payments on it, and at the end of that period, you leave the house. But under a capital lease agreement, the ownership of the asset is transferred at the end of the leasing period, unlike an operating lease where the ownership is not transferred. So basically, once they finish with the payments for, let's say, a certain equipment they have a capital lease agreement for, that equipment would now belong to the lessee. Companies do this because they're able to buy assets at a considerably lower price in the end, and also because they're able to generate revenue while using the asset without having to pay upfront for it. In this case, the lessee will make regular payments to the provider for a certain period of time that is agreed between both parties during the negotiation. So when you see capital lease obligation in the balance sheet, if it appears under current liabilities, it shows the total amount the business will pay within 1 year for the current active capital lease contracts they have. And these could be the payments for capital lease agreements that will expire within the next 12 months, or part of the regular payments that will be recorded for that period of long-term capital lease obligations that will expire in more than a year, which explains the portion of long-term debt we see here. Thus, if capital lease appears under non-current liabilities, it refers to the amount they have to pay in the long term for the capital lease obligations that, of course, has an expiration date of longer than a year. Because remember, anything listed under non-current is outside a 12-month timeframe. Coca-Cola has a total financial liabilities of $2.7 billion between current debt and capital lease obligation payments that will be recorded for this period. Down here we have provisions, and this is money that the business takes from its revenue to cover eventual costs in the future. So, for example, they can estimate the amount of employees who will retire in the near future and use this fund as pension provisions to cover those costs. For this reason, provisions appear in the income statement as an expense because it's taken from its revenue, and as a liability in the balance sheet because it will be used in the future to pay off obligations. So they have just over $1 billion set aside as provisions. Discontinued operations liabilities. They did not have any discontinued operations as we saw before in the current asset section, but this refers to the cost after operations are eliminated, like the compensation to all the employees in case a division or department was closed, for example. There are no more figures reported for current liabilities, so we can see the amount of short-term debt or current liabilities they have of $19.7 billion, which comes from the total payables and accrued expenses, total financial liabilities, which includes current debt and capital lease obligations, and total provisions. Let's now take a look at their non-current liabilities. It shows the long-term debt and the long-term capital lease obligation, which, as explained, are the payments for capital lease agreements that are longer than 12 months. Between these two, they have over $36 billion. Then, under tax liabilities, we have non-current deferred taxes liabilities. This is the company's estimate they will have to pay in taxes in a future longer than a year, due to an underpayment in taxes in the current period that will result in a higher future tax payment. And finally, other non-current liabilities. And these could be several different things they have to pay in the long term. They don't break it down here in Morningstar, but just to give you a few examples, it could be non-current deferred revenue, which is money that the business receives in advance for services they haven't delivered or provided yet, and because it's under non-current are scheduled to be provided in over a year. Imagine a car company offers a pre-sale for a new car that will be delivered to you in 18 months. This is reported under non-current liabilities because the service or product is still owed to the client. So the business cannot recognize whatever they received from this sale as revenue yet. And just so you know, you can also have current deferred revenue, which is reported under current liabilities, and it's essentially the same as non-current deferred revenue, but the prepaid service or products in this case will be provided anytime within the next 12 months. Another thing that could be included in these other non-current liabilities are some non-current payables, which is basically the same as accounts payable, so it's money that the business owes to providers. But in this case, the line of credit the provider gave the business is longer than a year, so the supplies will be paid in more than 12 months. It might also include bonds payables. These are payments that the company owes to their bond buyers that will be recorded outside the next 12-month period. And besides these things that have been mentioned already, it could honestly be any other number of long-term obligations for a total of $47.2 billion non-current liabilities. Total debt Coca-Cola has is at nearly $67 billion right now. Now, this is the equity section of this balance sheet. And remember that to get total equity, you simply need to take your total assets minus total liabilities. So all these numbers you see here in the equity section are just a breakdown of everything we reviewed before. So these are not additional figures, but they're just part of the numbers that we have already gone through. There are a few things we can highlight, such as retained earnings. This is a big part of total equity and important metric to look at. This is basically the portion of the company's net profits that we can see in the income statement that is not paid to shareholders as dividends, but instead is kept by the company to be reinvested. But just so you're not confused, because this is a little off topic for this video, let's just focus on the total equity number right here. I'll be making a video in the future about retained earnings so we can see it in more detail. Total equity for Coca-Cola is around $25.8 billion. This is the most important number in this balance sheet, and the one you mainly want to see increasing over time. Total equity is also referred to as net income available for stockholders, and here's why. If a company goes bankrupt, it must fulfill all its obligations first and shareholders are last. This means bond buyers, for example, have a priority of getting paid over shareholders in case the company runs out of business. And besides bond buyers, also banks they have loans with or suppliers they owe money to. And after all these obligations are fulfilled, shareholders receive a compensation or might not in case there's nothing left afterwards. And if you take a look at the structure of the balance sheet, it's a great example of this definition I just gave you. At the very top, you have all the assets and how much they're worth. But then, this value goes through several liabilities to get to the net income for stockholders. Now, of course, when you invest in a business, especially in the long term, you don't do it with the mentality that the business will go bankrupt, but that it will grow over time. So what are you looking for in this statement? You basically want to make sure the business is able to cover their debts and still be left with a good amount of total equity. Because this is a sign that the liabilities are much smaller than the assets, which tells you the business is financially healthy and capable of covering its obligations. Whereas, if total equity is very low or decreases over time, this means that liabilities are growing at a fast pace compared to the assets. And this growth, as long as it continues to be stronger than the assets' growth, is going to make the gap between them smaller and smaller, leaving you with less total equity, which can lead to bankruptcy. There are some useful metrics you can use when analyzing the balance sheet as well, such as working capital, which is the amount left of current assets after paying the current liabilities. Now, sometimes your total assets will be greater than your total liabilities, which is good. But simultaneously, your current assets can be close to or might be smaller than your current liabilities. That is why taking a look at working capital is very important. Because when you see it from a total asset versus total liability perspective, it might seem like the business is okay. But when you compare current assets with current liabilities, it shows you how the business is doing right now, in the current period. And if they have enough assets they can liquidate to cover those obligations they need to fulfill within the next 12 months. So always try to make sure the business is doing good by taking a look at the whole picture with total equity. But also, make sure it's doing fine in the current period using working capital by subtracting your current liabilities from your current assets. If you divide current assets with current liabilities, you can also get current ratio. And the result from this should be ideally between 1.5 to 2 at least. This tells you how big their current assets are compared to their current liabilities. For example, if a company has $1 million in current assets and $500,000 in current liabilities, your current ratio will be 2, meaning you have twice the amount of assets, or $2 worth of assets for each dollar of liabilities. Whereas, if you have a ratio lower than 1, let's say 0.5, this represents a liquidity issue because liabilities are greater. Or, in this specific case, you have 50 cents per each dollar of liabilities. Now, you might be thinking that the greater this ratio is, the better, because the business is more able to pay their debts. And certainly, it's much better to have a high current ratio than a low one. However, with very high ratios, let's say 5 or 6, even though you don't have a liquidity issue, it could be a sign of poor management of resources, because they might have a lot of cash that could be reinvested or a lot of cash equivalents and inventory they have not been able to sell. You can also calculate the total debt to total asset ratio. So when a business needs capital, they mostly raise it using a combination of debt financing by getting loans from banks or issuing bonds, and equity financing, which is basically giving up a percentage of ownership by issuing shares, for example, in exchange for capital. So what this ratio helps you know is what portion of the company's total assets are financed through debt. If a lot of their assets are debt financed, the company might run the risk of getting to default, because regardless of their performance, they need to pay their obligations. So they could be vulnerable during unexpected events that might affect their results, like COVID, for instance, recessions, or unexpected increases on interest rates. They might also find it hard to raise more debt from creditors, because the higher this ratio is, the more chances of not getting paid creditors have in case the company goes bankrupt. To get it, you divide total liabilities by total assets. In Coca-Cola's case, their debt-to-asset ratio is 0.72, or 72%. That is the percentage from the total assets that are funded by debt. Blue chips, or mature companies such as Coca-Cola, tend to use more debt financing than equity financing, so they usually have a higher ratio. However, Coca-Cola does seem a little too high in my opinion right now. You'll find companies from 30% up to 70% total debt to total asset ratio. But what determines whether it's high or not is the industry average, how big the business is, and also what the company does. So only compare this metric with similar companies in size and sector. Debt financing has some advantages compared to equity financing. It actually depends on each company's specific case and their financial strategy. But certainly, the lower this number is, the less vulnerable to default the business is, because it tells you most of their assets were acquired either from their own cash or through equity rather than raising debt. Now, before ending this video, I want to briefly give you an overlook at a much riskier balance sheet. So I'm going to take AMC as an example. The numbers of this big movie theater chain have been heard a lot. Not only they were strongly hit by COVID, but AMC specifically was very close to bankruptcy back then. But it suddenly became a meme stock, so everyone was talking about it on social media. It was trending for some time, and this bumped the prices of their shares and helped them raise millions of dollars that kept them from going to bankruptcy. However, they're still not in their best position. Here's an example of it. Just by taking a quick look, you can see that their total assets number is not very stable. But most importantly, the liabilities are growing faster than the assets. See how for the last couple of years, they had more debt than what their total assets are worth, leaving us with a negative stockholders' equity. Working capital has also been negative for some years, meaning for those periods, they had more short-term debt they have to pay than assets they had to sell, and their capacity to cover their liabilities is very weak because of the lack of liquidity. Their current ratio is 53%, meaning they have 53 cents per each dollar of current liabilities.
So, in a nutshell, when taking a look at this document, you mainly want to make sure that the business has considerably more assets than liabilities, and that the asset figure constantly grows over time. This is a sign of a financially healthy company, as they have less chances of going out of business. This is because they have enough funds available to survive and are less vulnerable than other businesses if they go through tough times. I hope you liked the video, and don't forget to subscribe and turn on the notifications if you want to get more content like this. See you.